All right, let's dive in. This week, MSCI made a huge call on MicroStrategy. And while the headlines look like a total win, the real story, the one that actually matters, is buried in the fine print. Turns out, it's a move that brings stability, sure, but it also comes with some brand new rules of the game. So let's break down what really happened.
So, the big question on everyone's mind, did MSCI give MicroStrategy the all clear? Well, yeah, but it's way more nuanced than that. What looks like a simple green light on the surface actually has some pretty complicated strings attached, and that's exactly what we're going to unpack right now.
You've really got two completely different stories here. There's the headline, which sparked this wave of relief, and then there's the reality, hiding in the details, which is, well, it's complicated. Our job here is to separate the good news from the, let's say, interesting news.
Okay, so let's start with the good news. This is the part the market reacted to, and honestly for good reason. It was a genuine collective sigh of relief.
And here's the headline grabber. Late Tuesday, MSCI came out and confirmed it. They are not moving forward with that proposal that could have booted companies like MicroStrategy right out of their global equity indices. That huge risk of exclusion, the one hanging over the February 2026 review, it's gone, off the table. And you can't overstate what a big deal this was. It took a major tail risk off the board. The big fear was a sudden, almost robotic removal from the index. That would have automatically triggered a wave of forced selling from all those passive funds, the ones that track the index, and have no choice but to sell if a stock gets kicked out. So, that binary in or out threat, it's gone, at least for now. You could really see this play out in the market's reaction, which was pretty telling. MicroStrategy stock, MSTR, closed up 2% on a day when Bitcoin was actually down 2%. That relative strength shows you the news was seen as a positive, but it wasn't exactly a champagne-popping moment. Think less wild celebration and more dodged a bullet.
Okay, but that's not where the story ends. Not even close. This is where we have to zoom in and really read the fine print. Because trust me, the details are everything.
MSCI was super clear about this. They called it a postponement, which is not the same as a final resolution. All it means is they're keeping things as they are for now while they go back and take another look at the entire rulebook. So the key takeaway here is this was not some big stamp of approval.
In fact, they specifically said they're going to open up a whole new, broader consultation about how to handle companies that have these huge non-operating assets on their books. So that fundamental question, how do we even classify a company like this long-term, is still very much up in the air.
But here it is, the most important detail in the entire announcement, the part that has some really major implications down the road. It's what we're calling the index mechanics freeze. Okay, so let me quickly explain how things are supposed to work. Normally, there's this really powerful feedback loop. A company like MicroStrategy issues new shares to raise money. Then, at the next rebalance, MSCI sees those new shares and increases the company's share count in the index. And then, boom, all the passive funds that track that index are forced to go out and buy more shares to match that new higher weight.
Well, guess what? That whole automatic loop is now frozen. MSCI stated very clearly that during this whole review period, they will not be increasing the index share count for companies like MicroStrategy, even if they issue a ton of new shares. That automatic buying pressure, it's on pause.
The impact here is huge. It means that forced buyer, the passive fund money, is now sitting on the sidelines. MicroStrategy could go out and issue $1 billion in new stock tomorrow, and its weight in the MSCI index wouldn't automatically go up an inch. It's a classic risk management move by MSCI, basically putting a cap on their exposure while they go figure out what the new rules should be.
So you put all this together, and what do you get? It fundamentally changes the entire risk profile for a company like MicroStrategy. The game is just different now.
So let's just put it side by side, the old fear versus the new reality. What used to be this risk of a sudden, mechanical, binary event, you cross a line and you're out, is now a much slower, more procedural and constrained process. Any future change isn't going to happen overnight. It's going to require a full-blown consultation. That's a totally different kind of risk to manage.
Now, one really important clarification here. We're talking about MSCI. This decision is a big deal for international investors, for sure, but it does not affect whether a company gets into major U.S. indices like the S&P 500 or the QQQ. Those deepest pools of American passive money, totally untouched by this.
So where do we go from here? This decision creates some really interesting ripple effects, and we're actually already starting to see them play out. So what's the logical next step? Think about it. If you can't rely on that automatic buying from passive funds every time you issue new stock, well then other ways of raising money suddenly look a lot more attractive. Non-equity funding becomes way more important. And this is a path MicroStrategy was already heading down anyway.
And you know what? We saw proof of this almost immediately. MicroStrategy's preferred instrument, STRCT, hit and held $100. In a world where issuing new stock is constrained like this, instruments that look more like credit become a much more stable way to raise capital. This MSCI decision just quietly poured gasoline on that strategy.
So if you had to boil this whole complicated announcement down to just one single sentence, this is it. MSCI is basically looking at MicroStrategy and saying, you can stay, but the bar is getting higher. The rules are tightening up, and the path to growing your index weight just got a lot harder.
And that leaves us with the big, final question. This move definitely removes a huge risk and brings a new kind of stability. But is that stability a solid foundation you can build on for future growth, or is it actually a temporary ceiling that puts a cap on things for now? The fine print has completely changed the game, and now we all get to watch and see how it gets played.